All right. So why is it important to do year-end tax planning? As most of us know, you know that one of my mantras is that April 15th is your tax filing deadline, but December 31st is your tax savings deadline. So when you do your final tax picture for the year, especially November, December, you have the opportunity to reduce your tax liability, even if it's just by a little bit, or even knowing ahead of time what's coming down the pike, whether you're going to owe or you're going to get a refund. It enables you to plan more, so this is an investment of time. Another thing that I've noticed from my perspective as a CPA, it's a lot easier for us when we're working on your returns now compared to trying to do them during tax time. Because even though we still have to repeat everything and do it during tax time, the fact that we already know what all you have that has happened for the year is huge for us, because now we're not stressed. We're not dealing with a lot of tax returns. We have time to breathe. I have time to really look at everything that you have going on, to be able to come up with strategies and implement things. Come, March, April, September, October, that's really compliance. And a lot of other people send in their returns to be prepared because everybody is in compliance mode. If I'm just seeing your stuff for the first time, it makes it very difficult for us to come up with strategies then. Plus, the year has already ended. So it's very important to start to, if you have not already done that transition. I see we have about 43 people who have sent in their documents so far. So thank you. We're looking forward to getting a lot more. But it's very important that you start thinking about year-end tax planning if you're very serious about building wealth, because there's some things that we're able to catch before year-end that we can't when it's the busy time. Okay? So you might be able to audit-proof your taxes and keep the dreaded IRS off your back. Stop unnecessarily employment taxes, increase your depreciation deductions, avoid passive loss limitations, get net operating losses, avoid being a dealer, sell properties tax-free to a 1031 exchange, invest in a self-directed IRA or solo 401k, structure entities the right way, fully deduct property tax losses against your income, legally transform capital improvements into deductible repairs, use seller financing, tax saving strategies, and avoid or reduce alternative minimum tax. So before you have to do all this, you need to make sure that, one, you're able to get all your documents together. Usually we're just asking you to send in your pay stubs, year-to-date income and expenses for your rentals or the business to see what you have done so far. So this is very critical. So the next thing that we're going to look at is please let me know if you can't see this. Let's see. So hopefully you guys can see this. Let me see the chat. Okay. Yeah. So if you can't see it, just let me know. What we want to look at now is the advanced tax strategies. One thing that I did want to mention with the advanced tax strategies is that most of the advanced tax strategies will save you on taxes, but a good chunk of them involves you coming up with money out of pocket. So outside of like cost segregation and maybe purchasing like a car where you use a good percentage for business, all the other strategies, they work, they will save you on taxes, but you need to come out of pocket. So let's say you have $10,000 to spend. The question is, would I rather pay Uncle Sam? Let's just say you're at a 30% tax bracket. Would I rather pay Uncle Sam $3,000 and have $7,000 left over? Or would I rather contribute or invest that $10,000 in something that is tax advantaged, save that $3,000, but at the end of the day, you've come out of pocket $7,000 into some kind of investment. So usually it's a matter of you deciding what's the best use of your funds with this year. And we have another client who I think she has about maybe 30 or 40,000, another client $80,000. And so one of the things that we have to decide is, does it make sense that this 80,000 goes towards paying whatever the tax liability is, or should we use some of it to contribute to the solo 401k, use some of it to pay the taxes, or use some of it to make investments that will give you a tax deduction. Remember that a tax deduction is not the same as a tax credit. So these deductions will reduce your taxable income dollar for dollar. It doesn't reduce your tax liability dollar for dollar. So one way of looking at it is that whatever it is that you put money into, you're only getting a percentage savings on taxes. So if you put 10%, you're at a 30% tax bracket. You're only saving only $3,000. It's not, oh, I invest 10,000 or contribute 10,000, then that's a $10,000 tax savings. No, it's a percentage. You have to tax effect that amount to be able to know how much is actually coming in your pocket. Okay, so I wanted to say that before we moved into these advanced strategies. And what I'll do is to do two at a time, take questions, and then move on to the next one. So the first one is oil and gas. Oil and gas, we found out that oil and gas can be very good investments. I've had clients who have invested in it. Some of them got their money back at the end. Some of them just barely broke even. But the advantage of oil and gas is that you're able to use the drilling cost to offset your W-2 income, capital gains, and you get an upfront tax deduction. So if you invested $25,000, you get a $25,000 deduction this year. So if you invest in oil and gas before year end, and by the way, you do need to act on that quickly, because these are strategies that a lot of people want to implement. And so if you want to move on the oil and gas, whatever you invest, you're going to get 100% tax deduction plus the return on investment that you get after 4 to 5 years. Okay. So that's oil and gas. And then you can use 1031 into a large established investment property. I just consulted with a client and we are looking at them doing a 1031. So if you're thinking about selling a property, rather than selling and getting the proceeds by year end, consider moving that cash into a larger property. You have 45 days from when you close to identify a replacement property. If it's a 1031, you do need to identify a qualified intermediary. That's the person that's going to be getting the money at closing. You cannot get the money at closing. If you do, it becomes a disqualified transaction. But the qualified intermediary gets it. Then you are able to use that money to buy another property. And you have 45 days to identify that property and then 180 days to close on it from the time of selling the relinquished property. You could also do a reverse 1031 where you actually purchase the replacement property first before selling your relinquished property. The only thing is that you would have to set up an LLC, and then the LLC is the one that purchases the replacement property, and then you will now use it. You will now use your name or the name of another LLC to sell the relinquished property. That way you can do it in reverse. You don't have to necessarily sell and buy. You can buy and then sell. But in either instance, the qualified intermediary needs to be involved. Okay? So these are two strategies that you can use for year end. I will stop sharing and take any questions that anybody has before we move on. Feel free to type it in the chat or to unmute yourself and ask away.
Good afternoon, Ebere. This is Ebony. Nice to see you.
Happy
Hello, hello. So for the first scenario for the oil and gas, is there a ceiling, a max amount that you can invest?
Minimum is 25. I think the maximum is 100, but I don't know. And I think they also do it based on the oil block and how many people want to invest. Irving, can you write that down so that we can ask Ryan what the maximum is? I know his minimum is 25, and I'll check as we're talking because I think he sent me the prospectus, but I don't know if there's any maximum. I think it's based on the number of people that are demanding, then they put on cap on how much you can invest.
Thank you.
How do you invest in oil and gas? So we do have a partner that we work with, and he helps with setting that up. So if it's something that you're interested in, we will just put you in touch with him, and then he'll look to see what blocks are available. And those blocks are available, then he'll, get you registered and signed up to do that. I'm also going to look to see if I can find the article that he sent us on that, so we can look at some of the details.
This is Samantha. Hi, Ebere.
Hi, how are you?
I'm good. Is that something that we can do from our business? If you would recommend that we do that from our business to buy oil and gas if we have extra income from the business, or?
Yes, the deduction is the same. So that's, yes.
Okay.
We actually have an oil and gas webinar that we did about 2 years ago. So if you're interested in that, please let me know, and then I will also make that available. And I'm also going to continue looking for the article that Ryan had sent us for that, so that we can review that as well. Any other questions?
Yes, good afternoon, Ebere. Good afternoon, everyone. I just have in regards to oil and gas, do we have to be accredited investors?
No.
Okay.
I don't know why I can't find this. I had this chat here that I wanted to share. I'll find it. I know it's here somewhere. Let me check this one again. If not, I'll send it out. I'll send it out when I do the recording. I'm not seeing it easily here. I may have moved it and then forgot where I moved it to. Let me check one more place, and if not, we will move on. 2022. Okay, I can't find it. So I'll look for it again. I know that Ryan sent me something, and we can take a look at it together. Otherwise, I'll send it out to you guys so that those of you that are interested in the oil and gas can let me know. Okay, so let us continue on.
Just one more question.
Mm-hmm.
So just to make sure I understood this correctly, you're saying that you could invest in oil and gas and that will lower your taxable income, like a 1-for-1, like a 401k?
Yes.
Does it matter? Oh, well, I guess you said it depending on the cap. Okay, got it. Thank you.
Okay. What's the duration for the oil and gas investment? It depends. Some are 4 years, some 5, some 10. But usually it's like it's like you're getting into a partnership. It's like a what do you call it? A private an investment in a private fund. So it's whatever happens, if they find the oil or the drilling, how long all of that takes. So some people 3-4 years they're out, others 5, others have been 10. It all depends on the oil well that you're drilling. Okay. If you have expenses for separate rental properties, but let me read it. If you have expenses for separate rental properties, okay, but buy those together, example, cleaning, how do you account for those? Do you just split 50-50? Yeah, so what we do is you can just do you can just prorate, and you can decide on the best methodology to prorate. Maybe you want to prorate based on the rent or prorate based on the square footage. You can just come up with a methodology to prorate and just prorate. Usually we call those general and administrative. So it might be like cleaning supplies. It might be if you hire like a virtual assistant and they're working different properties or, you know, different things. You can bring all of those together under one general and administrative expense and just prorate it across. Others maybe do based on the number of properties. If it's 10 properties, just divide by 10, same amount each one. You just need to come up with a methodology that makes sense and just allocate it across. Okay. Okay, Irvin, please write down the names of all these people that are interested in the oil and gas so that we can introduce them to Ryan. So I'm seeing Cynthia, Ebony. I see Brendan. Okay, Gary says, do you have to pay tax if you transfer your 529 to a self-directed Roth IRA? The answer would be yes, because you are going from pre-tax to post-tax. A 529 is a tax-advantaged account, and you are going into a taxable account. So the answer to that would be yes, Gary. Okay, they want us to share the oil and gas recording, so Irvin, note that. What's the number of buy-sell hold days for the 1031 exchange? So let's use November 1st. If you sell your property November 1st, you have till December 15th, 45 days from when you sell to identify the replacement property. Remember, you cannot get the proceeds at closing. It needs to be with a qualified intermediary. If you're thinking of doing this, reach out to us. We'll connect you with, what's his name? Blackacre. I'm seeing his name now. I don't remember his name, but we have a qualified intermediary that we work with all of our clients. And so we can, Bobby Levinson will connect you to him, and then he can tell you all the specifics. So November 1st till December 15th, 45 days to identify, and you can identify up to 3 properties. Then you have 180 days from November 1st. So that's what, running you through the end of April, on which you need to close on the property. Now, if you do a 1031 in 2023, let's say you do it now, because you have 6 months, April 30th, for which you need to close, you would have to file an extension. You cannot file your current tax returns while you are still in an active 1031 exchange, because the exchange could fail, or it could end up being a partial exchange, or something happens. You would need to complete the exchange first before filing your returns, because if it fails, then you have to pick up all the capital gains in 2023. If it succeeds and it's 100%, you defer 100% of the capital gain. If it's only a partial where you ended up getting some money at closing, then it's going to be treated as a partial. But keep in mind that if you do a 1031 exchange in 1 year and it falls into the following year, and by then you have the tax filing deadline, you want to make sure that you file an extension and complete your exchange before you file your tax return. Okay. So I moved out of my primary 6 years ago, rented it and sold it this past year. Okay, let me put my thinking, hold on. I like to write these things down. Moved out of primary 6 years ago, rented it and sold it this past year. Okay, so we don't qualify for 121 exclusion because it's been more than 2 years. I'm in the process of purchasing another primary, okay? Am I liable for taxes even though it used to be my primary? Very good question. Are you liable for taxes? Yes. Even though it used to be your primary, yes. Because the rule is that if you use it as your primary 2 out of the last 5 years, then you are able to get that $250,000 exclusion per taxpayer. So if you're married, $500,000. So let's assume that you moved out of your primary residence in 2022. Because you have 2 out of the last 5 years, that means you have 3 years more. You have till 2025 for when you can sell and still be able to defer the capital gain. But because you moved out of it 6 years ago, that means that you lived in it 2 out of 8 years. that doesn't qualify, unfortunately. Okay. All right, let's keep going. Can you use rental income to buy oil and gas option? Vas, I'm not sure I'm understanding the question, but if I think what you're asking is whether or not you can use oil and gas to offset rental income, yes, you can use the oil and gas deduction to offset your rental income. That answer would be yes. So just knowing a little bit about your personal situation, that would be my answer. Okay, thank you, Sharon, for stepping in and answering Kim's question. Is the oil and gas an investment or a tax deduction? It's a tax deduction. Okay. Irving, please note all the people interested in the oil and gas: Lynn Nehemiah, Cleo, Sam Bayana, Sam Haberlack. Okay, looks like we're gonna have to do another oil and gas presentation here shortly. So what I'll do is we'll try to Stephen Senior. Okay, what we'll do is we'll try to get you guys out the link for the oil and gas recording that we did, and also put you guys in touch with with Ryan. And if I have time, maybe we'll do one at the end of all the webinar series. We'll do an oil and gas kind of update after you've watched the webinar. If you have any questions, we'll discuss. Okay, so Deb inherited a property in Delaware, which was sold in 23. Okay, will I be taxed on the proceeds in Maryland? If so, how can I offset this profit? Okay, so let's think about this for a second. You inherited a property which is in Delaware. Okay, so you're gonna have to pay Delaware taxes. Depending on who you inherited it from. If you inherited it from your parent, mom, or dad, I hope that you guys did the appraisal to determine what the fair market value was at the time of their death. So whatever the fair market value is, less whatever you sold it for, you're gonna have capital gains. So yes, you will pay capital gains in Delaware, but you're also gonna pay taxes in Maryland, but you get a credit, a non-resident, Delaware non-resident credit for whatever you paid to Delaware. You're going to get a credit for that in Maryland based off of the Maryland tax rate. So Deb, I think you already sent in your information for the year-end tax planning. So I'm hoping that this information is there. So we'll run all the numbers and tell you what it is. Irving, can you also copy that out for Deb? Copy that out and send that to David as well. Okay, Sharon is interested in the oil and gas. Okay, Nikki, oil and gas. Everybody interested in the oil. Now I'm interested because you guys are interested. I'm interested. Sorry, let me stop. Okay. Lynn, my adult daughter is living rent-free in a DC rental property that I own. There are 4 other paying tenants. Would make the property now qualify as owner occupied? For example, how can I take the homestead deduction? You can't take the homestead deduction because you're not the one living there. It's your daughter living there. And it's not really owner occupied unless you're now saying that both of you own that property together and there's some kind of where she shares all the burdens and benefits. But your adult daughter is completely separate from you. So this would be a rental property for which you are having to pay taxes on. Okay. And we can talk about that offline, Lynn, as needed. Okay, I think I got through all the questions. Let us go ahead and continue on. Share my screen. Thank you, guys. Keep these questions coming. It makes our discussions very practical. That way I'm also dealing with things that you guys have questions on. Okay, qualified opportunity zone. You are still able to invest in a qualified opportunity zone, and you can actually pair that with an oil and gas to defer capital gains. Remember that the year to defer the capital gains is up till 2025. So even though you can still do the qualified opportunity zone, where at the time that it happened, it was 10 years deferral, now it's only 2 years because it ends 2025. But you're still able to do the qualified opportunity zone. Charitable structure, you are able to use a charitable structure to take advantage of itemized charitable deductions. Let me, hold on, let me get that. Okay, so for the charitable deductions, this leverage charitable deduction, you make a $30 contribution because you purchase the leverage charitable deduction. I think it's aluminum or some precious metal. I don't remember what it is, but Ryan has that information. I think it's aluminum or something. You purchase it for $30,000. You turn around and you contribute it to a nonprofit that uses aluminum in their nonprofit. Because you're contributing it at fair market value, you were able to get a $120,000 itemized deduction. It's like 3 times as much deduction because you are able to donate at fair market value. Okay. This other one is a little bit more complicated. The structured ownership program is where you invest in a business and you're able to get, you're able to offset your long-term capital gains and ordinary income, including wages. The minimum long-term capital gain, though, is $1 million, and your ordinary income has to be at least $800,000 for you to use. There's also a solar panel investment tax credit that you can get. That's also an advanced strategy, but the solar panel sells out pretty quickly. So we're also going to find out from Ryan whether or not we still have some solar panel deduction that's available. So those are the advanced strategies that we pretty much utilize in addition to those that have the regular 401k deductions. If you have expenses that you're going to incur first quarter of 2023, you can incur those expenses in December as long as it's ordinary and necessary, and you were able to get the deduction. If you have revenue or income that you're going to earn in December, if you're able to push it into the first week of 2024, you've now been able to defer that tax that you're going to pay on that revenue until 2025. Okay, so I will keep taking questions. What are the tax advantages of leasing solar panels in 2023? Leasing, not purchasing. Depending on where you're putting the solar panels, if you're putting it on the rental property, it just becomes a regular rental property deduction. Because you're leasing and you're not necessarily owning or purchasing the solar panel, you're just getting a regular deduction for it. And I'm assuming that we're talking about rentals. If it's on your primary, that solar credit, you're able to get the solar tax credit, but I think there's a limit on how much of it that you're able to claim on your individual return. Okay. Check in here to see if Mark did join us. If you have questions, please keep them coming. Let me check if Irvin, did Mark let us know whether he was going to come on or not?
He said he may be able to join.
Okay, that's fine. Yeah, we still have a lot to cover. Okay.
Ebere, can you go back and elaborate on the Opportunity Zone Fund? And is that once again, is that because I see the word fund, do I have to be an accredited investor?
The qualified opportunity zone. No, I don't think it's, I'll need to check, I don't think I've been asked that question. I'll check the rules, but I don't think a qualified opportunity zone fund you have to be accredited. The only requirement is that you have capital gains, either from the sale of stock or from the sale of a property that you can invest in the fund. But I'll check to see, Sir Irvin, if you can write that down. I'll check to see, but I don't think you have to, as long as you have capital gains, I think you're able to get the deduction.
Okay.
All right, so. Okay. A property needs to be in service to deduct costs. How do you get it in service as quickly as possible? And how do you treat expenses before and after it is in service? Okay. So For it to be in service means that you have listed it and made it available for rent. It needs to be available for rent. So you need to have it either in the MLS or Craigslist or Apartments.com, wherever it is that you typically would advertise. That property needs to be advertised and available. Now, just because it's listed and available and you don't actually rent it before year end is irrelevant. As long as it's, you're done with the rehab work, it's available. If a tenant were to come, you will go ahead and rent it out. That's what you need to establish that it's now placed in service, and any expenses that you incur from that point on after it's placed in service, you can now deduct. Any expenses before it is placed in service will be added to the cost basis of the property. Okay. Contacts for estate planning. We actually have 2 people. So Irvin, if you can note that, I'll send that to you. If I find, I'm trying to remember her name. I know Mark Milan is one person, but we have another person that all she does is estate planning. I'll try to see if I can get her name really quickly. Her name is escaping me. Let me try to see if I can get it. She's an attorney out of Maryland, but I'm not seeing her name easily here. I'll try and get that for you. So that would be Cleo. Okay. Yeah, I'm not seeing it easily here. I'll get it out. Send. I know Mark Milan is one, but then we have another person who's actually an estate planning attorney, and I'll get that to you. Okay, for the oil and gas investment, is there a probability of investment capital being? Yes, there are some people who have lost money, and it's the same thing with any investment that you make. If you make an investment, it's possible that you may not be able to get a return. So you do need to analyze the oil and gas on its own investment merit, not just as a tax deduction. So you do need to make sure that you do that analysis first. Okay, is solar beneficial for rental? Does the pro versus con? It all depends. It depends on what you're wanting to get out of it. If it's something that saves on electricity for the tenant, and you have some kind of arrangement where maybe the tenant is paying you a little bit more over and above what they would have paid, but then your solar cost is low, then maybe it's worth it. You just have to look at how much it costs to install it. Look at it, what they say lasts about 25 years and stuff, and see whether that depreciation cost spread out over time, if that's something that is worth doing. Okay. Regarding the in-service question, are the rules different if it's a short-term rental? No, the rules are not different as long as it has to be listed for rent. Okay, what if it was an STR in service January to June and is now being renovated? That means you can only get the deductions for January through June. From July to December, because you took it out of service in order to renovate, you will not be able to get all the costs incurred after you took it out of service is now going to be added to the cost basis. Okay. If you use a VA in the Philippines, do you send them a 1099? No, as long as they're not US residents, because I was going to say citizens, but you can be what do you call it? What's the name of it again? Where you're a permanent resident. You can be a permanent resident and still you get a 1099. So as long as they're not on US soil, you do not need to issue a 1099, but you do want to keep track of your expenses and all that. Is there a point of contact for the solar cost question? Yes, same person. That would still be Ryan Foncanon. He's the one that helps us with everything that has to do with the advanced strategies. Okay. All right, so let us go into more detail now with I covered it last week, but the charitable contributions. Let me share that. Okay, so if you itemize your deductions on your federal income tax return, you can deduct your gifts to charity, and this can also help you increase your gift. Remember that your deduction is limited to a percentage of your AGI. So it could be limited to 60% for public charities and 30% of your AGI. But any charitable deduction that you make that you're not able to deduct in the current year, you are able to have it transferred over. It's being carried over to the following year. So you can do cash, that's straightforward. Anything over $250, make sure you're getting a receipt for proof to substantiate the contribution that you made. And I know a couple of people asked about the donor advised fund. You can set up a donor advised fund. Donor advised fund is really where you set up, like, just like you have a regular brokerage account, but you set this up just for purposes of making charitable contributions. So you set up a brokerage account that is designated as a donor advised fund, and then you make a contribution to it. You are able to get the deduction in the current year. So if you set up a DAF before December 31st, you are able to get the deduction for 2023. However, you do not need to make a decision on which charity you're going to contribute to until whenever. And you don't have to make a decision about it until you can just let the asset grow over time and then make the contribution later on, make the designation for the charity later on down the road. And so you have DAFs that you can set up over $25,000, under $25,000, or one where you want to use the money within a year, then you make it a directed contribution. And all of these we can help you with setting up. You just reach out and then we can talk to you about those options. Okay. All right. Please repeat what you said about carrying over charitable. Okay. So your charitable contributions, let's say it's not to a public charity. So let's say you made $100,000 charitable contribution, but your income is only $120,000. If it's only $120,000, that means that you're only allowed to deduct $40,000, 30%, right? So that means you now have $60,000 that you contributed that you're not able to claim in the current year. You don't lose it, it just gets carried forward until the following year. So even though you're not able to claim the $60,000 because it's only limited to $40,000 based off of a percentage of your AGI, you are able to carry that deduction forward and claim it in the following year. All right, I'm going to keep looking for that information. If you guys have any questions, feel free to unmute yourself or type in the chat. Okay, I think I found it. Okay, let me share my screen. I found the information. We will also send this as well. Now, this was from back in 2021, but it's still the same information, so I'm still going to share it. And then I'm going to ask Ryan to send us the updated one for 2023. Okay? So Ryan works with the U.S. Energy Development Corporation. That's who he does the oil and gas investments through. So just looking at the last 5 years, how much was invested, these are the number of wells that they found, and then the cumulative tax savings that they've had to date, and the percentage of cash and tax savings that they've had to date. So for 2015, at the time we were looking at this, they had 127% return. In 2016, it was 92, 2017, it was 64, 2018, it was 40, 2019, it's 37. So pretty much saying that they've had a track record so far of being able to return more than just the tax benefit that they got, in addition to getting more money out of the well. Okay. Let's see. Okay, so you're allowed to be a general partner, and you get a deduction of up to 99% of your investment. So like if you invested 100,000, you get a $99,000 deduction in the current year. And then you can also invest as a limited partner. And then your limited partner, there's a special allocation that is done in terms of how the deductions would happen. You can also invest. I think somebody had asked me about this. You can also invest through your LLC. The LLC can be the one to invest in the oil and gas. And they have invested and drilled in more than 2,400 oil and gas wells in 13 states and Canada. Okay, let us see what else. Risk management. So this is something that they talk about, the risk management and the different things that they do. So I think this is pretty detailed. You can feel free to go to their website, or like I said, we'll send you guys out this information, and feel free, you can talk with Ryan directly. And after all the webinars, I'll try to maybe add one more webinar before year end where we can discuss more about the oil and gas. So,
Hello, Ebere. Stephen here.
Mhm.
How are you? Quick question. What does it take to be an accredited investor? I saw the screen panned by and it said accredited investor only. Is that something Ryan can help us with, or is it something we do
Yeah,
outside?
if I remember, isn't it 250 income and million in assets or something like that? Let me go back and see. I think it's 250 and 1 million in assets. Let me.
Does that change periodically, or is it
No.
fixed?
The accredited, yeah, the accredited investor rule is, unless SEC changes it, but
Okay.
you said you saw that here as we were scrolling.
Yeah, if you go scroll back up, it says accredited investor only. That's when you right below the returns that you were showing from 2015.
Okay, hold on, let me see.
Right there. Come scroll back down. It said fun facts right below fun facts. There you go. Accredited investors only.
Okay. So I'm looking for the footnotes. Oh, okay. So they're just saying to look at it. It's not included here, but it's included in the PPM. Okay. Let me see if he included that in what he sent us here. No, it's not included here. So we'll ask him more about that.
Okay, thank you.
Mhm. Okay. Can you use real estate asset as a charitable contributions? Yes, you can donate real estate at fair market value, and then if you owe taxes, these offset your debt to the IRS. Yes, but it depends. So I'm glad you asked that question. So because I know your specific situation, Celine, you brought up a good point that we need to discuss. There's actually a lot of taxes, but I'm just going to focus on 5. So you have federal income taxes, you have state income taxes, you have Social Security taxes, you have Medicare taxes. Okay, 4. And the Medicare and Social Security is what we call the employment taxes. If you make a charitable contribution, that will offset your federal and state taxes. It will not offset your employment taxes, which is your payroll taxes, Social Security, and Medicare. So if the liability that you have is coming from self-employment tax, then that liability you're still going to have that. So if you have federal taxes, state taxes, and then self-employment, which is payroll and Medicare, the charitable contribution could reduce your federal and state taxes. But if you're self-employed, meaning if you're a realtor or a rehabber or wholesaling, strategy, you have these cash strategies in real estate, you're still going to have self-employment tax. So that charitable contribution, even if it's your business that makes the contribution, it will not reduce your self-employment, which is payroll, which is Social Security and Medicare tax. Okay. Can you use a trust to invest in oil and gas? Yes, you can use a trust to invest in oil and gas, but you do need to make sure that the trust that you set up is disregarded and that the tax benefit still passes on to you as the beneficiary owner of the trust. If it's a complex trust where that trust has to pay its own taxes before it does the distributions or is required to distribute all of the income annually, then you will not be able to use the deduction to offset taxes on your individual return. So make sure that you study the trust that you have, work with whether it's an attorney, an accountant, to make sure you understand the kind of trust that you have set up before you invest in the oil and gas using that. Okay, I'll show you guys one final thing with the solar portfolio, and then we should be done. Again, if you have questions, please post it in the chat. Let's look at the solar. Okay, so this one here, okay, so with the solar purchase, you have 2.5 million purchase, and then you have the revenue and the expenses every year. And then you have the net income. After you take out the debt service, you're left with about $51,000 in cash flow. And usually the solar, they plan it out for about 25 years. So at the end of 25 years, which is here, you're now getting about $175,000. But the benefit that you get is that in the first year, because you invested 2.5 million in the first year, you get a federal tax benefit of 1.1 million. You get a state benefit of 160,000. So it's 1.1 million of the 2.5. So even though you are invested that amount in the first year, you are able to get almost 50% of that amount as a full deduction. In addition to the depreciation, you're also able to get the solar depreciated. You're able to get the benefit of depreciation in the first year as well. That's why things like the solar, oil, and gas, those kind of things that give you the upfront deduction in the first year are the things that we consider the advanced strategies. So I'll go ahead and send these out to you guys. You look at it, and like I said, for those of you that are interested, we'll put you in touch with Ryan, and he can talk to you some more about it. All right, we have just a couple of minutes, so I'll take more questions until 4. Do we need a report to the IRS our private REIT investments and dividends? Yes, if you generated income, if income was generated or you had dividends, every income that you earn, even when you steal money, you're still supposed to report it to the IRS. If you kidnap a child, believe it or not, if you kidnap a child and you took care of the child for the whole year, you're allowed to get a deduction. If you're illegal here, you're still expected to pay taxes. So yeah, if you do get dividends from your private REIT, you are supposed to report it. You are taxed on your worldwide income, even income that you earn in a foreign country. But if you pay taxes in that foreign country, you get a foreign tax credit. So just keep it in your mind that you do have your tax even if they're reinvested. Yes, you're still going to pay taxes on it, even if it's reinvested. You are taxed on your worldwide income. Okay. All right. Does that kidnapped child deduction come with jail time? Okay, so the IRS does not talk to the INS, does not talk to FBI, even when you have what is that money called again? Money laundering income, you're still gonna pay taxes on it. They don't care about all that. They're not, all they are is that it's earned income. You actually took care of the child, you get a deduction. It's funny what things are possible and available out there. All righty, guys, we have come to the end of this session. Have a great Thanksgiving. Please feel free to email if you have specific questions, and we will try to get these articles and all this material. I'll have Irvin put it into one document and send it out to you guys. And talk to you guys next week. We have our final webinar next week, Tuesday.
Yes, Ebere, in regards to that 28th webinar, is it the same concept and discussion as today?
No, we're going to be doing bookkeeping. I'm also going to talk about the Corporate Transparency Act, which is now a requirement that all businesses, every single business that is registered in the United States, you are required to now report who all the beneficial owners are. So this whole thing about forming in Wyoming and Mars and Jupiter and Nevada, all of that is gone because you are now required to list who all the beneficial owners of the entity had. And the penalty is $500 per day, each day that you don't report. And the requirement, and it starts in 2024, and actually, if you register a new one in 2024, you have 30 days from when you registered that entity to report. There's still some rules and laws coming out about that, but we'll share it because everybody needs to get ready for this. And then the question is whether or not accountants are supposed to be handling or attorneys are supposed to be handling. There's not a lot of clarity yet on that as we're waiting on guidance from the Corporate Transparency Act to tell us more how this is going to work, but it's supposed to start January 24. We don't know whether they're going to, push it. And this is from FinCEN, the Financial Crimes and Enforcement Network. So you can know how big this is on making sure that everybody gets registered. Now, you only need to register once. You do it in 2024, that's it. But it's going to be a nightmare. Can you imagine trying to get every single entity that is registered in the United States reported in the year 2024? So that's all I have. Talk to you guys later. Take care.
Okay, thank you. As usual, thank you.
Happy